about the windfall gains tax on oil refiners and how that's likely to change the dynamics of the sector. We have with us Pinakin Parekh, Executive Director, Metals, Mining, Oil and Gas, Cement Equity Analyst at J.P. Morgan, joining in on the show right now. Pinakin, hi, good morning. Great to have you on the show. Just wanted to understand, Pinakin, what is it that you've made of this tax on oil refiners, and whether or not there is any possibility, or a remote one at that, of any sort of rollback or reconsideration, or do you think that's not going to happen?
Good morning. Thank you for having me on ET Now. If we take a step back, this is what the second big policy intervention. We had the export taxes on steel, we had the export tax on iron ore, and now we have the windfall tax on oil producers and the export duty on diesel. The first one was essentially an inflation fighting exercise. Policymakers wanted to reduce domestic steel prices. It was not a revenue gathering exercise. This one, on the other hand, looks primarily to be a revenue gathering exercise. If you annualize, current numbers, the government would collect between $15 to $16 billion for the full year, and therefore, it remains difficult to see when will it be removed. The purpose of this is to make up for the excise duty cuts that were done for the downstream sector. Policymakers have said that they will review it every fortnight. It's difficult to say what are the variables which they will look at when reviewing it. Diesel cracks and GRMs remain extremely strong right now. So to that extent, for a refiner who's exporting product, even after the export duty, it remains very, very profitable.
Pinakin, looks like you're back at office. You're looking different.
Yes.
The background is looking different.
Yes, we are back in office.
No rainy day holiday, Pinakin. You are like
no
us.
Rainy day. Yes.
It always wonders me.
Somewhere I feel nice that it's not just us.
I know. Trust me, you work at home. Initially, when we came back, I used to think, I'm back, others are not back. Now life feels normal, Pinakin.
Yes.
Okay. My question to you is, the extraordinary crack margin what Reliance or refiners have enjoyed, that was always too good to be true. Now, whether government is taking away or whether the natural cycles would have come down, one or the other would have as it is played out. So do you think we should not really fret over it, mull over it, because it was too good to be true always?
Sure. So, I think refining in particular, just like oil, has a very, very different supply-demand dynamics, at least for this year, for the remainder of the year. What you have is globally demand is still strong. We have not seen demand destruction at $120 oil. Yes, demand has stopped growing, but nowhere are we seeing demand pull back materially. You have the two biggest refiner exporting countries, Russia and China, which for a variety of reasons are not able to export product. Now, this has translated into very strong cracks. Now, if we were to look at over the next 2 to 3 quarters, it's difficult to see how the product cracks come off. We are entering the seasonally strong winter heating demand. Given what's happening with European gas prices, diesel demand should remain strong. So you're right that if you were to take a slightly longer term view, yes, this GRMs are not sustainable. They would come off, but at least in the near term, it looks like they will sustain. If you take a refiner, any refiner in India, you look at consensus earnings estimates, nobody was even remotely building in spot GRMs. And which is why probably you're not seeing consensus earnings downgrades for the Indian refining companies, because everybody expected this to reverse over the course of time. But at least for the next 2 to 3 quarters, refining outlook remains very, very strong.
Let's get into specifics, Pinakin. And, after almost that life high moment, Reliance has, fallen all the way to 2,300, 2,400 thereabouts. With this steep fall that you saw on Friday, has the stock price factored in the worst? Because, for Reliance, to be fair, it's one of those special situation cases where it's not just this, but a lot of other factors as well are at play.
Unfortunately, we will not be able to make company-specific comments. So, I would let that pass.
Sure. Also wanted to understand, what do you think would be the impact on OMCs in specifically? Because, currently they have been losing out by selling retail fuel, petrol, diesel, etc. So, does this move of then curbing exports as well and taxing them sort of further hamper not just their profitability, but also that, that first case assumption of privatization, for instance?
Sure. So if you look at the headline losses for an oil marketing company, the downstream marketers, the headline losses, if you take the latest spot diesel prices, will be around 16, 17 rupees a liter. But these are headline optical losses because it basically, the oil marketing companies take most of their product from the market, and that essentially comes at the refinery transfer price. More than 80% of the product is sourced internally. So the underlying cash losses are far lower. We estimate on a system level to be around 5 to 7 rupees a liter. Yes, they are still making losses. What this policy move does, it gives the government the flexibility to pass on some further excise duty cuts to the oil marketing companies. Unfortunately, we do not know what it would be. And investors would have to wait till policy clarity comes in. But for the time being, what has happened is that there is a floor on the potential losses for the OMCs. It does not mean that they will start making huge amounts of profits, but we are basically moving deeper into regulatory territory, and profitability and profits will be determined by policymakers in terms of what duty cuts you see. The worry that we have is that what happens if oil prices were to move further higher from here? Now, JP Morgan globally believes oil prices would move higher. Various scenarios they pointed out for the next 2 to 3 quarters, and under most scenarios, oil does move sharply higher from here. And that is, I think, when the real test would come as to what policymakers decide to do.
Good morning. This is Nayantara. I'd like to move on from oil and gas and also talk to you about steel, metals. We can see what's happening with copper as well. I'll begin with steel. The earnings season is here upon us. The last time we spoke with you, you said the markets were pricing in a earnings contraction. We had also talked about the exports ban that had come in as far as steel goes. Prices have also been coming down in the last 2 months or so. For the steel pack, ahead of the earnings expectations, when we've seen what had happened earlier with the stock prices, what is your outlook?
So if you look at steel stocks in particular, probably the entire Indian metals and mining pack, right, they have corrected far more sharply than what the global and regional stocks have corrected. So to that extent, the markets are pricing in a very, very deep recession for these companies, for their earnings. And markets are essentially saying that, look, the earnings will keep on falling, not only this year, but next year as well. Now, underlying commodity prices have corrected. There is no two ways about it. Steel prices have fallen. But given where implied spreads are, if you are a regional steel maker, you're not making too much money. We have already seen production cuts start taking place. So it's difficult to see a large downside in steel prices. And if you look at stocks which are pricing in very steep correction in earnings, that looks difficult at this point of time. Having said this, stocks needs catalyst, and the number one catalyst for metals and mining sector is going to be any eventual China demand recovery. Now, the rains have pushed it out, but at least the JP Morgan team over there believes that you should see a very strong fixed asset investment recovery in China in the second half. That should support commodity prices in general, metal prices in particular.
But is there merit in lowering the multiples of both ferrous and non-ferrous companies, especially the way we've seen commodity prices move, the ugly R word for recession? You also just touched upon China, and if if demand continues to remain hurt.
Sure. So when you look at multiples, right? Generally, when you have your earnings upcycle, you use earnings-based multiples like EV/EBITDA. But when you are uncertain about earnings, you go back to price to book to figure out what are the trough levels for a stock to bottom out. Now, when you look at the large cap Indian metals and mining stocks, the benchmark trough is what happened during the global financial crisis. And the stocks today on a price to book are not much, further away from where they bottomed out back in 2009. Even though the underlying balance sheets have improved very, very rapidly, the underlying earnings is much stronger. The cash flow outlook is much stronger. So our point is that, look, we can debate earnings. We don't know how it will pan out. But if you take price to book as a trough, you keep earnings aside for a moment, and you look at where the balance sheet is today versus where it was in 2009. For some of the stocks, the markets are being too pessimistic versus what the underlying situation is.
Allow me to break this point for our viewers. Now, what Pinakin is saying, and just breaking it for benefit of our viewers here, because you deal with institutional investors who don't need to be explained this point. What Pinakin is saying is that when historically metal prices of stocks have bottomed out, they've gone to certain threshold levels in price to book. But that has happened when the balance sheets of some of the metal companies had a lot of debt. Because of last 18 months of bull run in some of the metals, the cash flows are better, prices have not gone back to those, cash flows are better, debt levels are not that high. As a result, the metal stocks will bottom out. The price to book levels would be significantly higher than what they were from previous cycle. That's a simple point he's trying to make across. So Pinakan, how does one judge that, assuming that this is a better cycle, cash flows are better, China steel is not coming, Russia steel is not coming, metal price will bottom out much higher. But what is that much higher?
Sure. So, I mean, the way to look at it is that historically there is a marginal spread globally where steel prices bottom out, and we are right now below those marginal spreads levels. So, to that extent, unless we see Chinese demand collapse from here, it's very difficult to make a case for steel prices to fall very sharply. What happens is that you have consumer destocking cycles, which tends to bring down prices for a couple of months. But eventually, if inventories are low, consumers come back and prices stabilize. So at this point of time, it looks unlikely that steel prices sustain below $600 a ton, given where iron ore and coking coal prices are. This will translate into still healthy margins for the Indian steel companies. What we would also expect at some point of time is, given that domestic steel prices have come off sharply, is there a rejig in the export duty that was imposed of 15%? If that happens, that would be seen as positive for the steel companies as
well. What could pour cold water on this bullish thesis? Could it be collapse in US housing market? Could it be something on the war front? I'm trying to discuss an unknown risk to you, from you, because if we knew, we would have discussed it. But sometimes you have to assume that things could go wrong.
Sure. So if you look at today commodity prices and commodity equities, they are essentially debating two macro risks. One is the risk of a US-Europe recession, and the other risk is of China demand not improving at all. And you could argue that commodities and commodity equities are pricing in these two risks to a certain extent. J.P. Morgan global view is that we do not have a US recession. Yes, growth slows down, but there is no immediate recession, and China demand rebounds. If I were to, say that what is the unknown risk at this point of time, which is not really priced in, it is what happens if energy prices were to move very sharply higher from here. We are entering into the peak demand season, the winter heating demand period. JP Morgan Global Commodities team has different scenarios. Oil can go to $190 a barrel, even $380 a barrel if Russian production were to cut down. If gas prices were to surge higher, thermal coal prices are actually 50% higher than coking coal prices. So I think sharply elevated energy prices, if they were to come through, their impact on overall economy, I think, is something which is very difficult to predict, and which is the real unknown over here. A US recession, a China slowdown is well priced into, to an extent, into the equities and the commodity markets.
I must compliment on the way you break it for our viewers, keeping it simple. That's the beauty of investing. Don't look at complicated things, keep it very simple. Metal prices are pricing in too much of pessimism right now. Got to ask you a question on cement, my friend, before we wrap. You've not changed your view there. I was hoping you would change your view, because if commodity prices, they come down, coal prices will also come down, oil prices will also come down. Why have you not changed your view there?
So the problem for cement is that the earnings outlook is dependent. Either you take the assumption that you have very large price hikes, which we find it difficult given the policy focus on inflation and the weak demand, or you believe that thermal coal prices will come off very sharply. The problem with thermal coal prices is that it is now entirely dependent by what happens in Europe. If Europe gas prices surge further from here, Asian LNG prices will also move higher. Europe is bringing thermal power plants. They are pulling in thermal coal from Asia. And we are already seeing thermal coal as being one of the stickiest commodities right now. They remain well above $350 a ton. And we are entering the next 2 quarters where demand-supply dynamics will further deteriorate. So in the absence of any cost relief for the cement companies, it's difficult to get bullish on earnings for the sector.
Great to have you on the show, and so glad to get in perspective on not just oil and gas, but metals as well as cement as well. Got a good 360-degree oversight.
Thank you.
Thanks.